Welcome to the Deep Dive. We're the show engineered to cut through the noise and get you straight to what really matters.
That's right.
And today we are diving deep into Rigetti Computing, Inc. Ticker is RGTI.
A big name in the quantum space.
Absolutely. They're right there at the bleeding edge of quantum tech. But here's the dilemma we're exploring. Is Rigetti on the verge of, a massive breakthrough?
Or is it more of a speculative bet, still kind of swimming in a pretty turbulent technological sea?
Exactly. We're going to unpack a company with, frankly, immense future potential. But that potential often clashes with its current financial picture. And there's this really interesting, maybe even troubling trend in insider ownership we need to talk about.
Yeah, it's definitely something to watch.
So our mission today, unpack Rigetti. We'll look at the business, the financials, how the market sees them, and of course the big risks and opportunities defining their future.
Got a stack of sources, analyses, reports ready to go.
And just for context, as of yesterday, July 31st, 2025, the stock closed at $14.50 a share.
Good baseline.
Also, a quick heads up for everyone listening. Rigetti's scheduled to report their Q2 2025 results on August 12th.
Just around the corner.
And you bet we'll be covering those earnings literally minutes after they drop. So stay tuned for that update.
We'll be on it.
Okay, so we've structured this deep dive into two main parts, just for clarity.
Makes sense.
Part 1 kicks off with Chapter 1, Business Understanding. Then we'll hit Chapter 2, Management Evaluation, and wrap up Part 1 with Chapter 3, Financial Analysis.
Solid foundation.
Then, in Part 2, we'll get into Chapter 4, Market Sentiment, Chapter 5, Ownership Structure, that insider story, Chapter 6, Risk Assessment, and finally, we'll bring it all together in Chapter 7, Conclusion.
Sounds like a plan.
All right, before we really jump in, just a quick reminder for you all.
Please do.
Like and subscribe to the Stock Analytics AI YouTube channel. Seriously, it helps us out. Plus, members get priority deep dives on tickers.
And we're covering all the S&P 500 stocks over the next few months. Members get that exclusive priority access.
Yep. And if you just want a one-off deep dive on a specific stock, drop us a super thanks. We'll get right on it.
We appreciate the support.
Okay. Let's dive into Part 1, starting with Chapter 1, Business Understanding.
Let's do it.
So, Rigetti calls themselves a pioneer in full-stack quantum computing. What does that actually mean in practice? How do they operate?
Yeah, full stack gets thrown around a lot, but for Rigetti, it's about their vertically integrated approach. It's actually pretty compelling. Meaning they handle the whole chain, they design their own proprietary quantum processors, they build the systems, and they manage the cloud platform to deliver access, from the chip itself all the way up to the cloud service layer.
Okay, so total control, basically, like building the car, the engine, and running the ride-sharing service.
That's a decent analogy, yeah. That comprehensive control is really central to their whole strategy.
Got it. So they're building this, super advanced tech. But how does that translate into actual revenue today? Where's the cash coming from?
Right, good question. Because the future potential is one thing, current dollars are another. They basically have three main ways they bring in money right now.
Okay.
First is quantum computing as a service, or QCaaS. This is really their long-term play, the cornerstone.
The subscription model.
Exactly. Offering cloud access through their own Rigetti Quantum Cloud Services, QCS platform, but also through major third-party clouds like Amazon Bracket and Microsoft Azure. That's meant for recurring revenue down the line.
Makes sense. What else?
Second, they do direct hardware sales. They actually sell quantum processing units, QPUs, like their 9-qubit Novera QPU.
I'll buy those.
Mostly research labs, government agencies, folks who want quantum hardware on their own premises.
Okay. And the third?
Third is technology development contracts. And right now, this is actually a pretty substantial chunk of their revenue.
Ah, so project-based work.
Precisely. Fixed fee, milestone-driven contracts, primarily with government bodies, DARPA in the U.S., the NQCC in the U.K., big players.
Interesting. So less recurring revenue there, more project-based.
For now, yes. And beyond those three, they also leverage their manufacturing chops with foundry and professional services. They can help others develop superconducting quantum chips or offer expertise on algorithms.
That's quite a mix. What are their sort of flagship products, the things they're really known for right now?
Well, their main system on the QCaaS platform is the Onco 3. That's their 84-qubit quantum computer.
84 qubits.
Yeah, and it's built on their patented multi-chip architecture. We'll probably talk more about that later. But they've shown pretty high fidelity with it.
Fidelity meaning?
Accuracy, basically, how reliably the quantum operations work. They quote, a median 2-qubit gate fidelity, a key metric of 99.0% for a specific operation called ISWAP. That's actually quite good in today's terms.
Impressive.
For the hardware sales, it's that Novera QPU. And underpinning everything is their Rigetti QCaaS platform software environment. But maybe their most unique physical asset, Fab 1.
Fab 1.
Yeah, it's the industry's first dedicated integrated manufacturing facility just for quantum devices.
Yeah.
A real brick-and-mortar advantage.
An actual quantum chip factory. Okay, that sounds significant. So what does all this Rigetti activity mean for the broader quantum industry? It sounds like things are moving fast.
Oh, incredibly fast. The whole quantum computing market is projected for just explosive growth. We're talking estimates from, say, $1.1 to $1.8 billion this year, 2025.
Okay.
Potentially rocketing to something like $5.3 billion, maybe even over $17 billion by 2034.
Wow. That's a huge range, but even the low end is massive growth.
It is. A Shikkei jar, compound annual growth rate of maybe 20-35%. It signals a really profound expansion is expected.
What's fueling that?
Several things. One, massive government investment. Billions flowing in from the U.S., U.K., China, Canada, all funding R&D.
Right.
Two, the dominance of cloud-based deployment, that QCaaS model we mentioned.
Yeah.
It makes quantum accessible without buying million-dollar machines.
Yeah. Democratizing it.
Exactly. Three, the convergence with AI. Quantum has this potential to turbocharge AI, especially for analyzing huge data sets.
Yeah.
And finally, you see intensifying patent activity. Everyone's racing to lock down the intellectual property. It's fierce competition.
Speaking of competition, who is Rigetti actually up against in this space? It sounds crowded.
It is. Rigetti, with about 140 employees, is what you'd call a pure-play quantum firm.
Just quantum, nothing else.
Right. Their direct publicly traded competitors include companies like D-Wave Quantum Ticker QBTS, though they focus more on a specific type called quantum annealing. Others are IonQ, Quantinuum.
Smaller, specialized players.
Yeah, but the elephant in the room, the really formidable long-term competition, comes from the tech giants. IBM, Google, Microsoft. They have almost unlimited resources.
That's tough competition. How do Rigetti's numbers stack up against, say, D-Wave?
Well, if you look at the market caps, they're both in the multi-billions. Rigetti around $4 or $5 billion. D-Wave maybe a bit higher.
Okay.
But then you look at revenue. Both are bringing in less than $10 million annually. And they both have substantial losses.
So minimal revenue, big losses, but massive valuations.
Exactly. It just screams that the market is valuing these companies purely on future potential, not on anything they're earning today. It's all speculation on the future.
And what about regulations? You mentioned government funding. Are there strings attached? Barriers to entry?
Definitely. National security is a huge factor. Yeah. The U.S. has pretty strict export controls on advanced quantum tech to keep it out of adversaries' hands.
That makes sense.
And foreign investments into companies like Rigetti get scrutinized by CFI-US, the Committee on Foreign Investment in the U.S. As for barriers to entry, they are huge.
Like what?
Extreme technical complexity, for one. It's incredibly hard science. High capital intensity building quantum computers and fabs is wildly expensive. Yeah. A global shortage of specialized talent. And as we mentioned, these extensive IP moats built by the early players and the giants. It's a tough field to break into.
Okay, given all that, the competition, the cost, the complexity, where does Rigetti actually stand out? What's their competitive edge, if they have one?
It really comes down to a couple of key things, I think. Less about traditional cost advantages, more about unique assets and their strategic approach.
Such as?
Primarily, that Fab 1 facility, their own in-house dedicated manufacturing. That is arguably their most significant asset.
Why is that so important?
Because it allows for rapid design fab test cycles. They can iterate designs much faster than competitors who rely on third-party foundries, which might have long lead times or less flexibility. Plus, they get tight quality control. This vertical integration could be a major long-term advantage.
Faster innovation, better control. Makes sense. Anything else?
Their patented multi-chip architecture. This is their technical bet on how to scale quantum computers. Instead of trying to build one giant, perfect monolithic chip, which is incredibly hard, they connect smaller, easier-to-make chips together to function as one large processor.
Modular design.
Yeah, exactly. Modular, designed to be more manufacturable and scalable. It's a distinct approach compared to some competitors.
So it's not just the quantum computer, but the how they build it, their manufacturing and design approach?
Precisely. And this whole setup, the full stack model with Fab 1, gives them this interesting strategic duality. Think gold miner versus pick and shovel.
How so?
Well, their ultimate goal is to achieve quantum advantage, find the gold. But Fab 1 also positions them as a potential pick and shovel player. They can offer foundry services to other quantum companies.
Ah, selling the tools to the other miners.
Right. And remember, most of their revenue now is from government R&D contracts, not commercial QCaaS. That suggests the gold market isn't really mature yet. So having that pick-and-shovel option via Fab 1 gives them strategic flexibility if the path to widespread quantum advantage takes longer than hoped.
Interesting. Strategic optionality. Okay, that gives us a good feel for the business itself, but who's actually running the show? Let's shift gears to Chapter 2, Management Evaluation.
Right, the leadership team.
What does the current team tell us about where Rigetti is headed?
Well, what's really fascinating here is the clear strategic pivot in leadership that happened. Rigetti basically shifted from being a founder-led, science-first kind of company.
Which is common in deep tech.
Very common. They shifted to one focused much more squarely on scalable manufacturing and commercialization. And that's embodied by the CEO.
Who is?
Dr. Subodh K. Kulkarni. He took the helm in December 2022. Now, his background. Over 3 decades in semiconductors, not quantum physics.
Ah, hardware scaling experience.
Exactly. He notably led a company called Cyber Optics through growth to a successful acquisition. Hiring him looks like a very deliberate choice to bring in someone with a proven track record in scaling complex hardware manufacturing.
Makes sense given the Fab 1 focus. What about the rest of the C-suite?
His CFO, Mr. Jeffrey Bertelsen, actually worked under Dr. Kulkarni at Cyber Optics before.
So they brought in a team that worked together successfully before.
It appears so, yeah. Suggests they imported a functioning executive partnership. The CTO, Mr. David Rivas, is more of a long-timer at Rigetti, with experience from places like Sun Microsystems and Nokia.
Okay.
This new core team, Kulkarni and Bertelsen particularly, came in after the founder, Chad Rigetti, departed. Their focus seems to have been stabilizing the company, securing funding, which they've done, and refining the tech roadmap, including that big partnership with Quanta Computer.
And how are they on transparency and reputation? Any red flags there?
From what we could find, they seem pretty transparent. Regular updates, earnings calls, accessible SEC filings. We didn't uncover any significant ethical or reputational issues with the current management team.
Okay, so experienced leadership focused on scaling. How are they managing the money side, given they're still deep in R&D? What's the capital allocation strategy?
Yeah, how are they funding all this innovation? Well, the strategy is pretty simple right now. Survival and technological advancement. Meaning basically all available capital gets plowed right back into aggressive R&D and expanding that Fab 1 facility. There's no room for anything else yet.
No dividends, no buybacks, I assume.
Definitely not. They don't pay dividends, no plans to, and they're absolutely in a capital raising phase through equity issuance, not buying back shares.
Right. They did a big offering recently.
They did. A significant $350 million at the market equity offering. That certainly shored up the balance sheet, gave them cash.
But diluted existing shareholders.
But resulted in significant shareholder dilution, yes. That's the trade-off at this stage.
Any M&A activity, or is it all organic growth?
No stated strategy for M&A. The focus seems entirely on organic development and strategic partnerships. That collaboration with Quanta Computer is key here.
Tell me more about that partnership.
It's a big one. A mutual commitment of over $100 million each over the next 5 years. It's about leveraging Quanta's manufacturing scale and expertise, presumably to help Rigetti build out their systems more efficiently.
$100 million each. That's serious commitment.
It is. It signals a major strategic bet for both companies.
Given all this spending on R&D, what does their return on invested capital, ROIC, look like? Is it even meaningful?
Meaningful?
Yeah.
Not really. Not in the traditional sense. It's deeply negative, depending on the calculation, around negative 64% or maybe 25%.
Ouch.
Yeah. But for a pre-commercial R&D heavy company like this, historical ROIC just doesn't tell you much. The entire investment thesis hinges on future ROIC eventually dramatically exceeding their cost of capital.
It's all about the future payoff. How long can they keep this spending up? What's their cash runway?
Based on their financial guidance and burn rate, it looks like they have a finite runway of approximately 2 to 3 years.
2 to 3 years, okay.
Which really underscores why making tangible progress on their technology roadmap isn't just important, it's absolutely crucial for their survival. The clock is ticking.
All right. Deep R&D spending, focus on scaling, finite runway. Let's dig deeper into the numbers themselves now. That brings us to Chapter 3, Financial Analysis.
Okay, the hard numbers.
How does Rigetti's financial performance actually look, especially when you contrast it with that multi-billion-dollar market cap we talked about?
Yeah, this is where things get, well, really interesting, or maybe alarming, depending on your perspective. It really brings up that central question. How can a company with such minimal revenue and significant losses command a market cap between $4.5 and $5.15 billion as of late July?
It's pretty extraordinary.
It absolutely is. And it just highlights the intense speculative fervor in the market for anything quantum related right now.
So let's look at the 5-year summary, say 2020 to 2024. What do the key metrics show? Revenue.
Revenue has been inconsistent. It actually peaked back in 2022 at $13.1 million. Then it declined in 2023 to $12.0 million and dipped again in 2024 to $10.8 million.
Declining revenue, why?
It highlights that lumpy project-based revenue stream we talked about, especially the reliance on those government contracts, which can start and end. They haven't hit that smooth, recurring QCaaS revenue ramp yet.
Okay. What about profitability, margins?
Not pretty. Gross margins took a big hit, falling from over 76% in 2023 to around 50% in 2024. And operating and net profit margins. Yeah. Deeply, deeply negative. We're talking negative 798% for operating margin and negative 1,493% for net margin of the trailing 12 months. Just huge losses relative to revenue.
Minus 1,400% net margin. Wow. What was the total net loss in 2024?
The net loss in 2024 was extreme, negative $201.0 million.
$200 million lost in 1 year.
Yeah. Now, that number was significantly impacted by large non-cash charges, things like stock-based compensation or changes in warrant values. But the underlying cash burn is still very high.
Which brings us to free cash flow.
Consistently and substantially negative. For example, it was a negative $61.7 million in 2024. The cash burn actually peaked in 2022 at negative $85.4 million. They are burning through cash rapidly to fund operations and R&D.
Okay, so the income statement looks rough. How is the balance sheet holding up despite these huge losses? You mentioned they raised capital.
Right. And this is where it gets slightly less alarming, maybe. Despite the deep operational losses, their balance sheet actually shows strong near-term stability. But, this is a huge but, this stability comes directly from those capital-raising activities, primarily the big stock offering, not from the business generating cash.
So it's financed stability, not operational stability.
Exactly. Their debt-to-equity ratio is super low, like 0.04. They've prioritized equity financing and paid off outstanding debt, which is good because it avoids interest payments.
Oh, okay.
And their current ratio, which measures short-term liquidity, is exceptionally high at 18.82. That indicates a massive buffer of liquid assets cash, basically.
But that cash came at the cost of dilution.
Precisely. That balance sheet strength was purchased through significant shareholder dilution.
I remember reading something about a positive net income figure recently, maybe Q1 2025. Did things suddenly turn around?
Ah, yes. That's a really important point and a potential trap for investors just glancing at headlines.
Yeah.
Rigetti did report a net income of $42.6 million in Q1 2025.
Which sounds great.
It sounds great, but it's essentially an accounting artifact. It was entirely driven by a $62.1 million non-cash gain related to the changing value of derivative warrant liabilities on their books.
So not actual cash profit from selling quantum services or hardware?
Not at all. The core business continued to burn cash. Their operating loss in that same Q1 was $21.6 million.
Yeah.
So investors absolutely must look past that headline net income and focus on operating loss and, more importantly, free cash flow to understand the real health of the business.
Got it. Accounting can be tricky. Given all this negative margins, high burn, reliance on financing, how on earth do you value a company like Rigetti? Standard metrics seem broken here.
They really are largely inapplicable. The PE ratio is negative, so it's meaningless.
Right.
The price-to-sales ratio, PS, which compares the market cap to revenue, it's astronomical.
Oh.
Currently around
146 times sales.
Yes. Which, okay, is comparable to their direct peer D-Wave, but it's orders of magnitude higher than any mature tech company. It just confirms, again, the valuation is purely based on hope and future potential.
Can you even use a discounted cash flow model, a DCF?
You can, but it becomes highly speculative. To get anywhere near the current share price of $14.50, you have to plug in some truly heroic assumptions.
Like
assuming revenue growth exceeding 70% annually for the next decade. And assuming they actually become profitable within, say, 5 to 7 years. Plus, you need to use a very high discount rate, maybe 15%, 20%, to account for the extreme risk involved.
So the model only works if you assume massive, sustained success far into the future.
Pretty much. Our own educational DCF model, running various scenarios, spits out a very, very wide intrinsic value range.
Right.
Something like $5 to $25 per share.
$5 to $25, that's a huge range.
It reflects the incredibly binary nature of this investment. Success could mean massive upside, failure could mean, well, much lower. The share price today, $14.50, sits right in the middle of that speculative range, but it's clearly not anchored by any near-term cash flows or earnings reality.
Okay, that paints a clear picture of the financial challenges and the speculative valuation.
Wow.
That brings us neatly into part 2 of our deep dive. Let's kick off with chapter 4, market sentiment.
All right, how's the street feeling?
Exactly. How are Wall Street analysts and the broader market actually perceiving Rigetti right now? Is the sentiment bullish, bearish, mixed?
Well, what's really striking here is the contrast. Wall Street analyst sentiment is overwhelmingly bullish, almost strangely so.
Really, despite the financials we just discussed.
Yep, the consensus analyst rating is a strong buy. If you look at the average brokerage recommendation on a 1 to 5 scale, where 1 is strong buy, it's 1.14.
Wow, that's very strong.
It is. 6 out of the 7 analysts covering the stock rate it a strong buy, and the remaining 1 rates it a buy. No holds, no sells.
Unanimous bullishness from the analysts. What about their price targets?
The average 12-month price target is hovering around $15.83, which, compared to the current price of $14.50, suggests only modest upside from here, interestingly enough.
So strong buy ratings, but targets aren't miles higher.
Okay, what about the general media tone? That's more mixed, I'd say. You see positive news often driven by their tech announcements, things like having gate error rates, developing new algorithms, that Quanta partnership we mentioned. Those tend to trigger rallies.
Right.
But then you also see more cautious commentary focusing on the valuation, the lack of profitability, the intense competition. So it's not all sunshine and roses in the headlines.
Makes sense. Now, looking ahead, earnings are coming up on August 12th. What are the specific expectations for that Q2 report?
Good question. What are investors anticipating? Well, the Wall Street consensus forecast for Q2 2025 earnings per share, EPS, is a loss of $5 per share.
A loss of 5 cents. How does that compare to last year?
It would actually be an improvement. In the same quarter last year, Q2 2024, they lost $0.07 per share. So analysts expect the loss to narrow slightly.
But does Rigetti have a good track record of meeting or beating these expectations?
Not really. They actually have a history of missing expectations more often than not. Just last quarter, Q1 2025, they reported a loss of -$0.08 per share when the estimate was for a loss of another some 5 cents.
So, a history of disappointment versus expectations. Has the forecast changed recently?
Nope. The consensus forecast of Nutterville Silver orders 5 cents has held steady over the past month. No big revisions up or down.
Okay. So bullish analysts overall, but maybe tempered expectations for the upcoming earnings given the track record. What are the broader market indicators telling us? How are investors actually positioning themselves?
This is where that contrast really sharpens. If you look at technical indicators, they actually look pretty bullish.
How so?
The current share price, $14.50, is trading above its 50-day moving average, which is around $13, and also above its 200-day moving average, around $9.30. Traditionally, that's seen as a positive momentum signal.
Price is trending up. Okay.
Yeah. But then you look at short interest, and tells a completely different story.
Ah, the bets against the stock. How high is it?
Exceptionally high. Estimates range from 18% to as much as 21.5% of the publicly traded float, the shares available for trading, being sold short.
Wow, over a fifth of the float potentially shorted.
Yeah, that translates to roughly 55 to 57 million shares being bet against. It indicates a very large, very significant contingent of market participants, often sophisticated ones, who are actively betting on the price going down.
So you've got unanimous strong buy ratings from analysts,
Right.
Positive technical momentum, and yet massive short interest indicating deep skepticism.
Exactly. It creates this classic battleground stock profile. Bulls versus bears, locked in a struggle.
What does that mean practically for the stock's behavior?
It means high volatility, likely. Any positive news, like a good earnings report or a tech breakthrough, could trigger a short squeeze.
Where the shorts have to buy back shares quickly.
Right, driving the price up rapidly as they scramble to cover their positions. But on the flip side, any negative news, the missed target, a competitor's advance, could validate that bearish thesis and lead to a sharp decline, potentially amplified by those shorts pressing their bets.
Right.
It's a powder keg.
A real tug of war. Okay, that market sentiment picture is clear bullish analysts, skeptical shorts. Now, let's dig into who actually owns this stock. That's Chapter 5, ownership structure.
Yeah, who's holding the shares? This often tells a fascinating story.
What does the ownership breakdown look like for Rigetti? Institutions, insiders.
Well, this is where we find that really compelling, almost contradictory narrative we hinted at earlier.
Okay.
On one hand, Institutional ownership is pretty significant.
Yeah.
It accounts for somewhere between 29% and 35% of the outstanding shares.
So big money managers own a decent chunk. Who are the top holders?
You see the usual big names: BlackRock, Vanguard Group, State Street Corp. And interestingly, these big players substantially increased their positions in Q1 2025.
Okay, institutions were buying recently. That sounds bullish.
It sounds bullish. But there's a crucial nuance here. A significant portion of this institutional ownership is likely driven by passive index funds.
Like Russell 2000 ETFs.
Exactly. As Rigetti's market cap grew, it entered or increased its weight in indices like the Russell 2000. Those ETFs are then forced to buy the stock, regardless of whether the fund manager actually likes the company.
So it's index inclusion driving buying, not necessarily active managers making a high conviction bet.
Precisely. It could be masking the true sentiment of active institutional managers who might be more hesitant.
That's a really important distinction. Okay, so passive buying might be inflating the institutional demand picture. What about insiders, the execs, the directors, the people who know the company best?
And here's where the narrative takes a sharp turn. In stark contrast to that institutional buying, insider activity paints a decidedly bearish picture.
How so?
First, overall insider holdings are relatively low, somewhere between 0.7% and 1.1% of the company. And second, over the past year, there has been a consistent, heavy pattern of stock sales by executives and directors.
Selling, not buying.
Selling. We found no records of open market purchases by insiders during this period, only sales.
Who's been selling?
Key executives. The CEO, Dr. Kulkarni, sold 1 million shares back in May 2025. The CTO, David Rivas, made multiple sales totaling over 670,000 shares. The CFO, Jeffrey Bertelsen, sold over 230,000 shares. Multiple directors have also been consistently selling shares they hold.
Wow, heavy selling across the board from the top leadership. No buying.
Correct.
So you have passive index funds potentially driving institutional buying while the people running the company are consistently selling their own stock.
That's the divergence. And frankly, this is a significant red flag.
Why is it such a big red flag?
Because it suggests that those with the most intimate, up-to-date knowledge of the company's prospects, challenges, and true valuation might view the current stock price as, well, fully valued or perhaps even overvalued. Their actions directly contradict the bullish public narrative being pushed by analysts.
Actions speak louder than words, perhaps. That's definitely something potential investors need to weigh heavily.
Absolutely. It's a critical piece of the puzzle.
Okay. We've looked at the business, the management, the financials, the sentiment, the ownership. Now let's synthesize the potential upside and downside. This is Chapter 6, Risk Assessment.
Right. Pulling together the strengths, weaknesses, opportunities, and threats, the SWOT analysis.
Every investment has risks and rewards. What defines Rigetti's high-stakes situation here?
Well, Rigetti really is a quintessential high-risk, high-reward proposition. Let's break it down with that SWOT framework.
Okay, start with the strengths. What does Rigetti have going for it?
Key strengths. That full-stack integration, especially the control offered by Fab 1, their proprietary technology, like the patents on their multi-chip architecture. A currently strong cash position thanks to those recent capital raises giving them that multi-year runway, and the experienced leadership with semiconductor backgrounds, which seems well-suited for the scaling challenge.
Solid points. Now the flip side, the weaknesses. What are the internal challenges?
The big weaknesses. Obvious lack of profitability, those deep, persistent operating losses, and high cash burn. Limited commercial traction so far with that heavy reliance on government R&D contracts instead of broad market adoption. Significant ongoing technological hurdles, scaling qubits reliably, improving fidelity, reducing errors. These are hard science problems yet to be fully solved. And, as we just discussed, that concerning insider selling, which is a major internal red flag about confidence at the current price.
Okay, weakness is acknowledged. But the whole point is the future potential, right? What are the opportunities?
The opportunities are potentially enormous. The massive total addressable market, TAM, for quantum computing, potentially tens of billions if the technology matures as hoped. Sustained government funding offers a stable source of non-dilutive R&D money. Strategic partnerships, especially the quantum computer deal, could provide crucial manufacturing scale and expertise. And the possibility of breakthrough applications if quantum can solve major problems in pharma, finance, AI that could dramatically accelerate adoption and Rigetti's value.
Huge potential upside if things go right. But what could derail them? What are the external threats?
The threats are just as significant. Intense competition, not just from other startups, but especially from the tech giants like Google and IBM with their vast resources. The risk of technological obsolescence. What if a competitor succeeds with a completely different quantum approach, like photonics or trapped ions? That proves superior. Slow market adoption is a big one. They could simply run out of cash before quantum finds widespread commercial use. And the overarching threat is the dreaded quantum winter.
Quantum winter sounds ominous.
It is. It's the scenario where technological progress stalls, commercial applications fail to materialize across the industry, and funding just dries up. For a company like Rigetti, burning cash and years away from profit, avoiding that kind of industry-wide stall is absolutely critical for survival.
A race against time and technology hurdles. Beyond these company-specific factors, how do broader economic or global issues impact Rigetti?
That's an important question looking at external vulnerabilities. Macroeconomics matter. As a capital-intensive company that will likely need more financing down the road.
Right, that 2 to 3 year runway.
Exactly. A prolonged period of high interest rates could significantly increase their cost of capital. Raising more equity might become harder or even more dilutive if market conditions tighten.
So the Fed's decisions actually matter quite a bit to them.
Absolutely. And then there are geopolitical factors, which pose some pretty acute threats for Rigetti specifically.
How so?
Well, hypothetical U.S. tariffs, say in 2025 or beyond, could disrupt their supply chain for critical components, increasing costs. But much more critically, there's that strategic partnership with Quantum Computer.
Which is based in Taiwan.
Precisely. That partnership places Rigetti squarely at the center of U.S.-China geopolitical tensions surrounding Taiwan. Any serious trade dispute, sanctions, or worse, conflict involving Taiwan, could severely jeopardize or even destroy that crucial collaboration.
Wow, that's a massive geopolitical risk exposure.
It really is. While things like the U.S. Chip Peace Act might offer some long-term benefit to their U.S.-based Fab 1, the near-term disruption risk from the Taiwan situation is substantial and potentially existential for that partnership strategy.
Okay, a complex web of risks and opportunities. Let's try to bring it all together. This is Chapter 7. Conclusion.
All right, the synthesis.
So after digging through all this, the tech, the team, the money, the market, the risks, what's the final verdict on Rigetti Computing?
Well, I think what's most striking is that profound contrast we keep coming back to. It makes Rigetti just a quintessential high-risk, high-reward investment. There are compelling arguments on both sides.
Summarize the bull case for us again. Why might someone invest?
The bull case rests on pure-play exposure to the potentially transformative quantum computing sector, differentiated technology, specifically that integrated Fab 1 and their patented scalable multi-chip architecture, a now fortified balance sheet giving them that multi-year runway to execute, validation from strategic partners like Quanta and government agencies like DARPA, and that strong, unanimous, bullish support from Wall Street analysts, for what that's worth.
A compelling story of future potential. Now, the bear case. What are the main arguments against investing?
The bear case is equally potent, maybe more grounded in current reality. It emphasizes the extreme valuation, fundamentally disconnected from minimal revenues, substantial losses, and high cash burn. An unproven commercial business model still heavily reliant on those lumpy government R&D contracts. Formidable competition from tech giants with deeper pockets. That deeply troubling pattern of insider selling. And the inherent binary technological risk success depends on making difficult scientific breakthroughs that are far from guaranteed.
So, bulls see the future, bears see the present reality and the insider signals. What about valuation? Can we pin a fair price on this?
Honestly, any attempt to assign a precise intrinsic value to Rigetti today is just highly speculative. As we discussed, our educational DCF model, even with aggressive long-term assumptions, gives that incredibly wide range, $5 to $25 per share.
So the current price of $14.50 is right in the middle of that huge uncertainty band.
Exactly. It's not anchored by current performance, it's floating on future hopes.
So what's the final word? Who should even consider investing in RGTI?
Look, Rigetti really represents a binary investment outcome. Either they succeed in becoming a foundational leader in a revolutionary industry, or they likely falter. The current share price is essentially a market bet on that successful outcome.
High stakes.
Very high stakes. The bull case has allure, but the bear case is strong, particularly concerning the valuation, the ongoing losses, and those insider signals. Therefore, Rigetti seems suitable only for investors with a very, very high tolerance for risk.
And patience.
And a multi-decade investment horizon. This is not a short-term play. And even then, It should probably be treated as a purely speculative position within a much larger, well-diversified portfolio. Don't bet the farm on it.
Sound advice. Now, for our listeners, a final provocative thought to chew on.
Okay.
Consider this. In a field like quantum, brimming with technological promise, how do you personally weigh that immense future potential against the stark realities of today's financial performance? And how much weight do you give those quiet but potentially powerful signals coming from the insiders who know the company best? Is Rigetti at its core right now primarily a scientific endeavor hoping to become a business? Or is it more of a market speculation riding the quantum hype wave? And what does that distinction mean for how you might approach an investment like this?
Something to really think about.
Indeed. That wraps up our deep dive into Rigetti Computing. We hope you feel much better informed and ready to think critically about this really fascinating, complex company.
Hope it was helpful.
And please, remember to like this video and subscribe to the Stock Analytics AI YouTube channel. It genuinely helps us keep these deep dives coming.
Don't forget, members get priority access for deep dive requests, and we're tackling the entire S&P 500 soon. Members get first dibs on those too.
Yep. And if you just want one specific stock covered, drop us a super thanks on YouTube. We'll add it to the list.
We really appreciate your support.
As always, remember that this analysis was generated by an AI system. It's for educational and informational purposes only.
It is absolutely not financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks for joining us on the deep dive. We'll see you next time.